We'll just get your thoughts on the first session of the week.
Well, we started off on a good note. The leads were good for the Australian share market. We looked like we may even break that 6,000 point mark, but then the China numbers came out and that was the end of the story. We gave up all of those strong gains from the morning and the market finished in the red. Now, if we have a look at the China trade numbers, expectations were that imports would see a fall of about 10% and that exports would grow by 10%. If we have a look at what actually happened, we saw the exports falling by 14.6% and imports down by 12.3%. So both of these numbers disappointing on the downside. Now, these were the numbers for March, so we were probably seeing a bit of payback from the Lunar New Year. And remember, in February, we did see the very strong export numbers with export growth of 48.3%. So we were probably seeing a little bit of payback there. But unfortunately for the Australian share market, this was bad news, especially for the material sector, which saw the biggest losses of the day. We have a look at the intraday graph of the Australian share market. You can see that we finished at the lows of the session, and that's before trying to break that one-year high that we've seen at 5,996.9 points. We got within half a point, so we got up to 5,996.4, but we didn't actually manage to get anywhere further than that. If we have a look at the Aussie dollar too, a big impact today, and if I try and bring up the Aussie dollar, you can see when those numbers came out, the Aussie dollar just absolutely got smashed there. But you know, over in China, over in Hong Kong, we saw the sort of reasoning, don't fight against the central bank, and these bad numbers really building on hopes that we're going to see more stimulus coming through from China. So stimulus hopes helping markets over there. The big numbers to watch this week are going to be the Chinese GDP numbers, which are out on Wednesday. Now, consensus is for 7.1% growth. That would be a slowdown from 7.3%. But given that these numbers have been, the trade numbers have been so soft, there are expectations growing now that we could even see a print below that crucial 7% mark.
Michael McCarthy, before I get when we get there, inevitably we will, but I suppose it's just when.
At the May interest rate cut. I guess if we have a look at the market, it's really being driven by this hunt for yield at the moment. We saw what happened in February once we saw that interest rate cut. We saw things like the banks absolutely rallying hard after that interest rate cut. So I think the next catalyst for the market to reach above that 6,000 point mark is certainly going to be a potential May interest rate cut for the Aussie share market, and that would fire along the banks once again, those higher yielders on the Aussie share market. And this is not just an Australia-centric story with negative yields in a lot of places like Sweden, like Switzerland, like Japan. The hunt for yield is a global one, and Australia certainly does have some still very attractive yields. But I think if we do see another rate cut here domestically, we are going to see some domestic support for those high yielders.
You don't think another cut potentially in May would perhaps already been factored in, priced in, Julia?
I think it has been mostly factored in, but I think we will still see quite a big reaction in terms of those high yielders. And I guess if we have a look at the strange thing about the market is that historically there's actually a high correlation between the market rising and interest rates going up and the market falling and interest rates going down. But unfortunately, with the artificial environment that we are seeing globally with zero interest rate policies in a lot of countries at the moment, that traditional relationship that we've seen has really broken down. And what we have seen is that interest rate cuts, stimulus, quantitative easing, great news for markets. In fact, if we have a look at markets around the world, the Japanese market has been outperforming, the German DAX has been outperforming as well. And I guess one thing that comes about when we do see interest rate cuts, stimulus and quantitative easing is the impact on currency. And in places like Japan and in places like Germany, which are key exporters, when you see that low currency, it's great news for their economy.
David Manch.
Well, I guess if we have a look at resource downturns, they can take a long time for the supply-demand dynamics to balance up and turn around. And if we have a look, for example, just in the case of metallurgical coal, thermal coal, look at uranium, all these examples where it does take a long time. So there's no huge rush, even though there may be value in some of the big miners, and you don't actually know when the prices are going to bottom out either. So you could be waiting a matter of 18 months. And I think in the type of market that we're in, investors are a little bit jittery. They do prefer to take a safer line, especially when some of their investments, like the high yielding stocks, are seeing returns of 30, 40, 50% in the last 18 months. And the energy and the material side of their portfolio obviously seeing a loss of around about that 50 to 60% mark. So I think there's a lot of pain in that area. I don't think there's a lot of rush, and I think a lot of investors are waiting to see the signs that there is a bit more of a balance between supply and demand instead of that massive supply that's coming online before they really jump into the water here.
David, is that